Good afternoon. It's 4 p.m. and it's time for another Digital Transformation Thursday. Today, I think will be our last episode for the year, and I think it's a fitting topic that we are discussing today. I think it's unique for two reasons. First, I think this is one episode where if you get to listen and you pick up something, you might actually make money from what you learned today. And second, I think for me, it's a nice way to end this year for Digital Transformation Thursdays, because I think a lot of the things that we're going to be talking about are going to play itself out, at least we think so, in the coming year. Before we start, I'd like to just remind everyone who's logging in, if you want to receive a certificate for today, all you have to do is register at dtt.ph, and you can sign up on the Zoom sign up, and then we will send you a link tomorrow, and then you can make a donation to get your digital e-certificate. And we're very happy for your donations. All the proceeds from your e-certificate submissions will be given to our COVID frontliners, and we've already given to PGH and the house here in the UP College. In the UP campus. And so we'd like to thank you for that. We'd like to thank all our speakers also who have given their time today for that purpose. Okay. So today it's going to be a little different. Instead, we have more of a guest, I guess, than a speaker. Instead of speaking on the topic, which is investing in cryptocurrency, our guest Colin Goltra we will have a conversation instead. So it's going to be a little challenging for me. I know I ask everyone to tell me where they're from. Please still do that. I'll make a note and we'll do a shout out later. I always like to think that we have people coming in from all over the country, even though we're a small, tight group. So please do that. Please tell us where you're coming from, and I'll do a shout out later. All right. I think I'm going to need a piece of paper to write this down. But anyway, let me introduce Colin first. So our guest today is Colin Goltra. He's the director for Southeast Asia Growth in Binance. He was a graduate at UC Santa Barbara with a BA in Economics, Statistics, and French. And he also studied, how do I say this? Sciences Po Lyon Institut d'études politiques. He studied economic policy, international finance, and management. He worked as an investment banking analyst for technology M&A at Lazard Frères, and spent some time at Samsung Global Innovation. In the Philippines, he joined Coins.ph as head of product development, talent, people ops lead, and as head of the cryptocurrency program. And currently, he's the country director and Philippines market lead for Binance. So I'd like to welcome Colin Goltra. So Colin, if you could, there you go.
Yeah. Hey, attorney, thank you so much for having me.
Yes, we're very excited to do this. Now I just need to figure out how we're going to present. Okay. All right. Okay. So our topic today and our objective, so this is going to be a little challenging. Our objective today is to talk about cryptocurrency and how people can invest in cryptocurrency. And I think we begin our story with the start of cryptocurrency, which is blockchain, right? And Satoshi Nakamoto. What can you tell us about blockchain?
Yeah, absolutely. Thanks for having me, and hello everyone. I'm very happy to be on the program. I think to get started, I'm very happy that Attorney Decini and others are doing programs like this, because when you hear about cryptocurrency, I think a lot of people have positive impressions, negative impressions, maybe misleading impressions. Certainly, there's a lot of misinformation out there. There are horror stories of people, speculating on scam projects or on illicit use cases for these things. And I think, I hope to dispel, some of some of that information. Hopefully dispel some of the incorrect information, and happy to show the warts and places where some of these things are places to do proper diligence. But yeah, I mean, I think to Attorney Decypting's question, I think the foundation of Bitcoin, the creation of Bitcoin happened at the beginning of 2009. So it just turned 11 this year. It's about to turn. It's going to turn 12 at the beginning of next year. At the end of 2008, in a cybersecurity cryptography focused mailing server or mailing list, an individual by the name of Satoshi Nakamoto sent a very basic PDF file, a white paper, which outlined the prospect of an internet native digital currency, right? And so at the time, it was just a random group of people. I think there's a couple hundred people on the mailing list, and it has grown from that into a fairly multiple hundreds of billions in market cap. Increasingly a store of value globally for wealth. And so yeah, this foundation moment was a figure who they thought was using a real name. Simply, he didn't even submit code just yet. It was just a spec outlining an incentive model and a computer network, and how in a decentralized way you could create a way to track value, right? And that decentralized thing, that decentralized ledger, is called the blockchain. And that for those that maybe know a little bit about engineering, it's really just a data structure, right? Prior to Bitcoin, you had to trust somewhere that a database was inputted correctly, or that, and maybe I'm jumping ahead of us here, attorney, but yeah, I think essentially the blockchain is this data structure that allows for true scarcity provable scarcity on the internet, and basically from that you can build currencies, you can build new network models that allow for people to join without in a way that minimizes trust, and yeah, I think from there, there's been a lot of people like me who've dedicated their careers into expanding this technology.
Right. So, I mean, the way I like to think about blockchain is that it's an invention that allowed for trust in a situation where nobody's in control. So traditionally, when you say, when you try to build a system, any kind of system, right? You say you have to have somebody in the middle whom you trust. In a payment system, there has to be somebody in the middle who's going to say, yes, there's really money behind this. And yes, you're the owner of that. And that's all centrally controlled. Bitcoin puts that on its head and says, we trust it because it's decentralized. So the decentralization is actually its strength. And the more decentralized it is, the lack of centralized control makes it actually more trustworthy. And and then that seems to go hand in hand with the way the internet itself exists. The internet exists because, and it's stronger the more decentralized it is. Although we do know that some parts of the internet are actually highly centralized, but in this particular case, blockchain is actually highly decentralized. And the reason why there's trust, I think, is because there's transparency. And transparency, go ahead.
Yeah, and actually, I think this brings up maybe a bit of a paradox in the cryptocurrency ecosystem, right? I mean, I think certainly there's a lot of people who think this is an anonymous currency. That's why it's going to be used for certain illicit activities. And the reality is actually, Bitcoin is a system that works because everyone is watching everyone else, right? And you might not know who's being, who is transacting or acting in a given thing, but the way it actually works is, everyone agrees on a set of rules beforehand, that transactions will be in a certain format and these sorts of things. Everyone's keeping a copy of it on all of their computers. And so if anyone were to diverge from it in order to try to forge the record in some way, it would be, because everyone's watching everyone else on this blockchain, it would be very difficult to forge that, because you would have to have enough network hash power basically to overwrite everyone else saying, no, this is a false transaction, right?
Right.
But yeah,
that's what we're showing everyone right now.
Yeah, it relies on that hyper transparency in a weird way, even though it also creates certain privacy. Has historically created sort of privacy and self-ownership things. There's this paradox where even though it creates individual empowerment, there's also this transparency that is incredibly revealing, right?
Right. So what we're showing here are actual transactions that are actually going into the blockchain, the Bitcoin blockchain right now. So it shows transactions as they are coming in, and this is the strength of the blockchain, that because it's transparent and because nobody is in control, then everybody trusts. Basically, you're shifting trust away from people and more towards processes and machines. That's the way I'd like to think about it. Go ahead.
Oh, and a quick thing, just if that obviously that visualization we just saw, which is I think a real time thing from a site, one of those transactions was $87,000. Another one was $45,000. One of them was something was less than $100. So there is when we say trust, there are very serious layers of you can see $27,000. You can see some fairly large transactions there. Yeah, 267. There's some very serious money being transacted here, and it's been trusted in this way for over 11 years now, right? Going on 12 years. And so we can get into some of the specifics a little later on, but because it's open source, people have every incentive to hack this and to find vulnerabilities, because it can, in theory, if you did that, you'd be able to take control of funds or route them to yourself in some way if you could find a vulnerability. But it's been battle tested by people actively looking to find these bugs, for more than almost 12 years now.
So I think one of the first questions that people ask about this is this secure?
Yeah.
Right? Is the blockchain secure?
Yeah, exactly. So as I fleshed out, I think maybe cybersecurity people and lawyers may be alike in some sense, in which we don't want to speak with purely definitively, right? That to the best of our knowledge, there's some sense where it's like, there you can kind of outline incentives. Look, there's a $2 million transaction right there on the screen.
Oh wow, yeah.
Yeah. So there's some sense in which there's every incentive for this thing for someone to find vulnerabilities in this, and it has gone basically without any sort of hiccups in the exchange of value for 12 years. So it is secure to the best of our knowledge, and despite every incentive for people to find ways for it not to be secure.
Okay, but we have heard stories of hacking situations. I think the earliest one that was famous is the Mt. Gox, and I think there have been other hacking incidents. Are those hacks on this blockchain?
Yeah, great question. So we should separate a few different things here, right? So there, at a base level, there's the blockchain, and the blockchain is the ledger for a given cryptocurrency, right? So there's the Bitcoin blockchain, and the blockchain is the ledger upon which you transact Bitcoin, in a sense, right? In order to obtain, if you have no cryptocurrency already, you have fiat currency, you have U.S. dollars, Philippine peso, and so in many ways you need some place to bridge the divide between the legacy or the national financial system and this new cryptocurrency financial system, right? And so those points often happen at the exchange or the wallet level, right? So I work at Binance, which is one of the, which is the largest exchange in the world. There's other well-known ones here in the Philippines, CoinsPH, PDAX, these sorts of things. Now these are centralized companies, which are essentially transacting, they're serving as like port cities between, between between financial systems, right? And so there are vulnerabilities often at this level because they are centralized databases that in theory can be hacked. And so there is, every year there's usually one or two that fairly high profile ones of, $100 million, $50 million. There's been now a track record of several of these. These are flaws in a single entity's security system and is different than, and generally speaking, have not yet been from any flaw in the underlying code of what Bitcoin is, right? This would be the equivalent of saying, is the central bank, or is the Philippine peso flawed in some way if a bank were hacked, right? I think that would be the equivalent maybe statement, right? A single bank could be, be robbed or hacked in some way, but that doesn't mean that the underlying currency system that it's supporting is flawed in some way.
Right. So that's the way I would think about it as well. So essentially, what we're seeing is that, what we're saying is that the blockchain is sort of like the definitive ledger, right? It's the main ledger, yeah. And that ledger has never been hacked. But
correct.
But normally, in order for you to buy Bitcoin, you would need to deal with what's known as a cryptocurrency exchange. So you log into a cryptocurrency exchange, and there's a wallet there. So if you open an account, say with coins.ph or PDAX or Binance, you will be given a wallet, and that wallet, it is those sites and those wallets that are hacked. So it's not the ledger itself. It's more of the cryptocurrency exchanges that have had security issues in the past, but I think less so in recent history. So and so one way to protect yourself, right, in that situation is you put your money, or you buy your crypto in an exchange, and then you take it out and you put it in a cold wallet. I think that's the right.
Yeah.
I'm wondering if we're getting ahead of ourselves. So maybe we'll go back to the Bitcoin story. So Bitcoin starts out in 2009, and so the way it works is that as a reward, right, for recording these transactions, there are these miners, right, and the miners get Bitcoin. So initially, these miners were getting all of the Bitcoins. And back when it was, right, I don't know, maybe 3 people, I guess, initially when it started. And then it was that for many years, correct?
Yeah. So maybe something that's helpful is I often teach what the blockchain is by analogy, right? Mining was once a useful mental model because the process of creating a Bitcoin has properties of seigniorage, right? Seigniorage is if you are someone that creates or introduces a commodity into a market, you get the value of introducing it, right? We can use it colloquially, but actually for people that are just beginning, it often sets them on the wrong course of how to think about the blockchain, right? Because they think that there's this discovery process or something. So the way I would teach the blockchain is this. So if you had like a market or a bazaar, like an in-person one, the way the traditional financial system works is everyone's making trades. If you had no money, right? If everyone was making trades, let's say everyone's making trades in a market, and then there was one person at the top of the market, maybe a chief of the village or something, and you said, "Hey, Attorney Decypting and I just made a trade. Please record it in your book." Right? Every trade in that market or something gets recorded in the centralized book. In a small environment, this is probably okay. You probably trust people in your own community. The issue with this is it doesn't scale. So if it was someone with one book and many communities or something having to record all the transactions, you might not trust that person is recording everything the way they say, right? They could write, they could write things to their own interests, these sorts of things, right? There's, in crypto language, you would say that this is a single point of failure, right? So that person with the book cannot always be trusted in order to write transactions in their book truthfully. So the way you would maybe get around this is, at the end of the day, everyone in the market has their own book, and at the end of the day, everyone's recording it. Everyone's recording their own transactions, and so everyone has a copy of the book, right? And so what this does is, if any one person tried to change the accounting of their own book and tried to submit that as the truth, everyone else could say, no, all of the rest of us recorded something different, so you must be lying, right? There's this consensus mechanism where everyone's paying attention to the transactions in that market, and therefore no one can kind of forge that ledger, right? Let's say now, for the new sake of things, everyone's recording their own transactions, but you do need some definitive book, right? Basically, what mining is we want to reward people who record all of these transactions, right? Because the more people there are recording every single one of these transactions in the market, the harder it is to forge a transaction, right? And so, but it's also, maybe a little laborious. You don't want to be one of the ones. In theory, you could take advantage of the fact that, and you can trust that a lot of other people are recording it, so you wouldn't have to. So what you need some sort of reward mechanism that that keeps people incentivized to make many copies of this ledger, right? And so that's what the process of mining is. For everyone that's taking a copy of their own ledger, in order to strengthen the resiliency of the network of that market, everyone recording their own ledger is entered into a contest that gives them a little bit of extra money, right? So let's say everyone's writing a page. At the end of the new page, there's a lottery between them, and whoever wins that lottery, they get to just write their name at the bottom of it, and they get to add money to their account, right? And that kind of keeps everyone incentivized to keep coming back, to keep recording transactions, right? And that's as close as I can get to the proper analogy for what mining is, right? In Bitcoin, you needed some sort of fair process to introduce some extra coins into the market, right? Because the alternative is you would either start at all of the coins, in which case, who do you give the coins to? Or you would start at, you'd give some other distribution based on maybe unfair factors that don't matter right away, right? So instead, the way that new Bitcoins are issued is that they are, they're given in a lottery formation to computers that are supporting that network, right? And hopefully, I realize this is a tough concept to engage with on a first call. So I'm happy to go into that a little more. I think for those that maybe have some context of blockchain, mental models already, that can be a helpful way to think about it. But I'm happy to go into more specifics there, Attorney. What do you think?
Right. Actually, I'm trying to look for a chart. So I guess the reason why I wanted to, if we go back to 2009, this is essentially a digital asset, and a blockchain basically tells you who owns a Bitcoin, right? That's basically what the blockchain contains. Okay, so I finally found a chart that I think goes back.
Yeah.
Oh no, it's hard to look. I'm looking for a chart that goes all the way to 2009, but the early ones I'm seeing are from 2013. So let me just see if I can share this. So there is this is a chart that shows the price of Bitcoin from 2013. So you can see here it was, what was the price? $100. So it went from, I guess, 0, right? And then
technically it started at 0.0 something. And that was based on how much electricity it cost in 2010. Something like that. How much electricity it cost in 2010 in order to create? Yeah.
Right. So we just take this. So 2013 it was $100, and then there's a bump here, and then it went up to, what is that, 500 USD? Oh, it's almost 1,000 USD.
Yeah.
So this
and
is
by
way
the way,
back in 2013.
at the time, that seemed as equally large a mountain as the ones you see over there. So at the time, $1,000 Bitcoin was just
unbelievable,
crazy idea. Yeah, unbelievable. Yeah.
Right. I mean, because when something is starting from zero, right?
Yeah.
Or you say, even if you say you started at 10 cents, and you say, you know, at 10 cents, who would think it would even go to $1? Once it hit $1, it hits 10, and then it hits. So then it hits 1,000. Right.
Actually, attorney, a fun exercise here. So there's at the bottom there's a slider which allows you to switch to the dates. So if you switch the far right one, the one on the other side,
the one on the right,
and then and then move it to like middle of 2014, you'll look that it's basically the same exact chart pattern as you see, just in smaller scale, right? Yeah.
I don't know if I'm doing it right. So.
Click here. On other way around.
Oh, the other way around.
Yeah. Okay. So start there, and then have the end date be, middle of 2014. Yeah.
So we're looking at this pattern here, right?
Exactly. Yeah. So look at that just mountainous pattern, and then now look at what it looks like when you moved it all the way to the end date to 2014, which means it shows the blips in
the blips in my machine, because it's So I think what you're saying is that this thing, which looks like it's a small bump,
was at the time a mountain.
Looked like a mountain. Okay, let's see. Oh, there it is.
So there it is. Yeah, see, at the time it looked very much like this, and at the time it just seemed like an unconquerable. Oh, now it's different. But
I know. I did it wrong again. So there
we go.
Okay.
Yeah.
There you go. Right. So you're seeing it was at what is it? It's like $100, and then it went up
to like $1,200, something like that. Yeah.
Yeah, that's my remember. Yeah, 1,300 here. Yeah, I think 1,200. That's the peak, and then crash almost immediately. Right. So November.
Yeah.
By January, by December, it's back to $500.
Yeah.
Right. So it's very similar to the and then what you call it? You call this a winter, right? Price kept going down.
Yeah.
Until 250 sometime in 2015. And then we moved this slider now to include 2017. And then we see the same pattern, right?
Right.
Where it's going to jump up. There you go.
Yeah.
Right. So
exactly.
So here we went from 250, right?
Yeah.
And now it jumps to 20,000 US, right?
Yeah.
For 1 day.
Right.
And then massive drop in a matter of, so it peaks in December, and by January it loses like half its value, right? It's what you call that dead cat bounce, right? Up to like 15 or something, and then down. So So now we're at so then it goes into this winter, right? In 2018, I guess 2017, 2018. I think the bottom was around December. My recollection was like December of 2018, about 3,500.
Yeah, we had some. There's a period there where we were back to 3, and that.
Yeah, so that's around December 2018, and since then it's a little movement, but then we go to March of 2019, and I want, maybe there's something we should talk about called the halvening, right?
Yeah.
Something to do with the number of Bitcoins that are rewarded to the miners. And go ahead.
So in my analogy about the market and the ledgers, everyone's got the book, right? I said that you needed some incentive to keep people writing in their books. And so you had some lottery system that gave people the amount of that allowed people to add amounts to their book, right? In theory, so one of the key attributes of Bitcoin is that it has a fixed supply. There will only ever be 21 million Bitcoins, right? And so over time, you need some way to issue less and less currency to the people recording in the ledgers, which in this case are the miners, right? So over time, you actually want to, with predictable on a predictable schedule, you need some way to issue less to the miners. And so on day one, that was already determined when the supply decreases would happen. It happens every 210,000 blocks. And so a block is like a single page in the ledger. So every 210,000 blocks, a block is about every 10 minutes. And so that lasts about every 4 years. So Bitcoin was launched at the beginning of 2009. The first halving was in 2012. The next halving was in 2016. And then there was another halving this past May in 2020.
Right.
The initial issuance for miners is if you were one of the early miners mining before 2012, you would get 50 Bitcoins if you won a block. And in the early days, there was almost no one in the network, which meant there were people regularly just winning 50 Bitcoins a day, right? And now, of course, if 50 Bitcoins at a roughly $20,000 price is about $1 million, right?
Right.
So back then it was quite nice, right? Well, back then it was almost worthless, right? So those people off boarded and stuff. Yeah, right. But what they deserved to be compensated extra early on because they were the ones who took a chance on this network. It wasn't worth anything at the time. They were the ones that they needed to be rewarded for their upfront fool's errand at the time, and so they got more of the network because they were early adopters, right? And so there was an issuance curve, and so in 2012, 50 Bitcoins per block as the reward got cut down to 25, and then in 2012 it got cut down to 25. In 2016,
so the 2016.
In 2016, it was cut down to 12.5. And then now in 2020, it was cut to 6.75.
Okay, so I'll just point out something to our audience, right? So you said that in 2012, this halving, right? So happened, right? So in 2012, it happened, and the Bitcoin price peaked in end of 2013.
Correct.
Right? Now you said in 2016 it halved again, right?
That's true.
And then by the end of 2017, is it here?
You need to capture more of 2017 on your map.
Oh, sorry.
Yeah, on the bottom. Yeah.
Right. So what happens is it halved in 2016, and then it boosts to 20,000 in 2017, right? So the halving here, right, somewhere here, and then it boosts. And then what we're saying is in 2020, right? Sometime in May, I believe, right?
May, yeah.
In May of this year, the halving happened, and
May of this year is middle of the chart. Yeah, there we go.
Yeah. Middle of the chart.
We're starting to build
somewhere here.
Yeah.
Right. So the price here was 5K. It says 5 or 6.
No, that's May 2019.
Oh, sorry, that's May 2019.
2020 is
about 10,000. Right. And then right now it's more or less doubled from that point.
Yeah.
And
it's 19,000 roughly.
Yeah. So if we follow the pattern, then where we are today, if this will happen again, right? Then we are somewhere right? I think we would be somewhere in late 2016.
We would be right. Our analog would be that we are at the end of 2016, which actually we're at the end of 2016 or the end of 2012, both of which were build years for Bitcoin, right? Or actually we'd be like end of 2016 or beginning of 2013, because the halving is slightly more than 4 years, or slightly less than 4 years. And so, I can explain a bit of that phenomenon if you'd like.
Okay.
I think a reason for that, right, is you can assume there is a supply of Bitcoin and there's a demand for Bitcoin, right? This is economics 101, right? The demand for Bitcoin and the supply of Bitcoin are often, in theory, they should be largely independent, right? So in a given moment, the demand for Bitcoin changes based on its own factors, but it doesn't change based on the supply of Bitcoin. And the supply of Bitcoin determines who's selling, which not every, There's a lot of people, we call them hodlers. They're people holding on that they don't want to sell because they see the long-term vision of this. So at any given point, the float of Bitcoin, which is the supply of Bitcoin, is only determined based on who's willing to sell. A lot of people won't always sell, or how many new Bitcoins are issued into the ecosystem. Now, when the block reward decreases, that's a giant change in the supply schedule, right? So in any given day, there are now half as many Bitcoins, whereas the demand did not change in proportion in relation to that. And in fact, demand continues to increase because we're continuing to build out our ecosystem. We're building infrastructure, access points for corporations and high net worth individuals, right? Our job as people in the cryptocurrency industry is to build tools to meet rising demand. We have no control over the supply schedule, right? And so as the supply cuts down and demand increases, ultimately that is, you have a slow build in demand and a rapid cut in supply every 4 years. It creates this effect where increased demand is now chasing after a much smaller supply. And when that happens, in standard economics, right, you start to be willing to pay more for it. Right. And so I think we've been seeing that squeeze. We've seen that squeeze in the past, and it appears we may be in the middle of another one of those squeezes right now.
So just to say that another way, perhaps from a layman standpoint. So my understanding is that there's this great technology called blockchain. It's being applied to Bitcoin. Bitcoin looks like the decentralized payment platform in the future. Like, it could be like a global currency, because if I have Bitcoin and if I can buy something that is priced in Bitcoin somewhere else, then I can make that transaction happen. And there's no government control. Price is transparent, etc. And what's happening, my understanding is that there's been more technology being built around Bitcoin as a payment system, and as adoption comes up, there's going to be demand for the currency, right? And that and sort of excitement around the future value of the currency, and therefore this drives the demand for the currency and the price. But I think so that's, for me, it's like Bitcoin 1.0, right? So Bitcoin as a payment system, and everyone's looking at it and saying, this is sort of a great way to replace, say, credit cards, because the fees are going to be lower. It's going to be more efficient. It's decentralized. I can send money from, my relative can send money from me from Saudi Arabia. I receive it as a Bitcoin. If I can turn it into Philippine peso, then I win, right? All the fees are going to be much lower. Sometime, I guess, I don't know when, maybe this time around 2017, there's this concern, right? That, well, you see, the thing about Bitcoin, at least as I understood it, it's a great idea, but the technology and the blockchain technology itself wasn't really comparable to, say, even the credit card system. It could not process as many transactions. And so, there were doubts about whether or not this thing could really be a payment system. But then the price kept going up, right? And now it's shifted to the way people view Bitcoin now. It's more of like they're calling it digital gold, right? So it's not something that you're going to use to, like, we don't use gold to buy anything at the store, but then people invest in it anyway as a store of value. So maybe you can explain that to us?
Yeah, sure. So a few things there. So let's talk about the efficiency of the blockchain, right? So in 2015 and 2016 and 2017, there were a group of people more on like the corporate enterprise side who would say, okay, this Bitcoin thing is no good. The blockchain data structure is very cool, and they thought that everything was going to be built with the blockchain, right? And that I think was a lot of naivety, right? Like it is a new data structure. It is a new form of technology, but it's not the old. Like, it's not necessarily the things that it excels at is to create a trustless system. But that trustless system is actually not very efficient, right? So when I use the analogy of someone was using the ledger, right? Someone was doing the ledger individually, and now everyone has to do the ledger. If you actually think about it, that's a lot more work and a lot less efficient if you just think of in terms of man hours, right? So in that sense, the blockchain is very inefficient, but that inefficiency is in order to achieve other goals, right? About being censorship resistant, hard to manipulate. It needs to be independent of any one country, these sorts of things, right? So yeah, there was a moment where there was a sudden moment where people kind of realized, well, the blockchain by itself is not just a magic solution to all technology problems. It solves a certain case of distributed systems problems on the internet, right? And that's one piece of technology, but not all of the technology world. So for payments and stuff, it's probably still more efficient and scalable to use a single database, right? Or a much smaller set of databases. So that might be like a Visa or a MasterCard, right? So that's kind of the efficiency debate, I'd say that Attorney Decypting raised, right? And so I'd say on the other piece of this is Bitcoin is now used, because the blockchain itself, at least the Bitcoin's blockchain, is not always efficient, and so it's not always convenient to do a small payment. What it is, instead is secure. It's secure. It can't be tampered with. It has a lot of computers behind it, and that makes it a very good store of value, right? And so rather than being able to do many small transactions, it is able to do very, very large transactions in a way that is very hard to tamper with, right? And it does that in a permissionless way. So that's where this store of gold or store of value or digital gold narrative came from. Bitcoin is a very secure way to keep your wealth stored in a digital means that is very hard to tamper with. The reason gold has value is gold is reliable, it's durable, it's very widely accepted across the world. People have, you can't really counterfeit gold. It's very easy to do that, right? And for the reasons I outlined previously, based on how many people are on the network to support Bitcoin, Bitcoin has many of these same properties, and that makes it that has historically made it a great store of value and a way to keep your actually the most important thing about gold, by the way, is it's scarce. And it has the best thing about gold is it's theoretically scarce. There's fairly predictable inflation for gold, right? And Bitcoin has something even better, which is it is provably scarce. There will only ever be 21 million Bitcoins. And so that creates long-term deflationary pressure. And so in a world where central banks are printing money, there's quantitative easing, these sorts of things, the supply of Bitcoin is fixed in a world where, the denominators for a lot of other things are rapidly accelerating. And so the security of it and the scarcity of it and the, it's pretty widely accepted globally. If you have a Bitcoin, you can usually find a way to get sold for cash anywhere in the world. These make it a very good way to unplug some of your wealth from the financial system historically.
So my understanding with Bitcoin is that the people who invented it, either Satoshi Nakamoto is an individual or a group of people, they believe that they had distrust. I think they're fairly could be called libertarian, right? So they distrust central government, and they don't like the idea that centralized government controls money and the value of money. Yeah. And I think one of the things that people are probably not aware about fiat currency, and so currently today the global reserve currency is the US dollar. I think people are under the impression that the US dollar is backed by gold. In fact, that's not true, right?
Yeah.
So I think that
we could get a little political about what it is backed by. Yeah. Which is well, we won't get into that, but
so essentially, this thing is under control of the U.S. Fed, and the U.S. Fed can keep on printing money, thereby sort of reducing as you have more money, then US dollars, then the value of the US dollar will go down. And those are driven by politics, and those are driven by politicians. And the way the Bitcoin designers, right, Satoshi Nakamoto, their thinking was, we don't want to be controlled by that. We want to be controlled by something that's transparent.
Correct, yeah.
And that's why they designed this.
Go ahead.
Sorry,
a real quick statement to that. So the mailing listserv that the original Bitcoin white paper was sent to was a group called the Cypherpunks, which is similar to kind of the 80s and 90s cyberpunk, but actually cipher is a cryptography term. And the cypherpunks have manifested in a couple other ways. They manifested in WikiLeaks. So Julian Assange was a cypherpunk of sorts. They've manifested in many sort of strong, applications of cybersecurity like PGP, pretty good privacy, and others. And so that Bitcoin traces its lineage directly from that cypherpunk milieu. And the cypherpunks believed a few things. For starters, they believed that that cryptography would protect the individual, right? That cryptography was a tool in a world of collectivist nation states to for individuals to protect themselves and self-empower. It was very libertarian. It was and is very libertarian. And I'd say economically, there's a set of economists that they really look to called the Austrians, the Austrian Economic School. And the Austrian Economic School believed a few things. So they believed that gold was, the gold standard was the original, that gold itself was just the best form of currency known at that time, right? They were very strong gold bugs for all the reasons I outlined, that it's scarce, it's not able to be counterfeited, these sorts of things. And then Austrians also had other ideas around, well, if governments can issue a currency, anyone should be able to issue a currency, right? This was from Ludwig von Mises. He believed that, in theory, if why can't Chase Bank issue their own currency if most nation states can issue theirs? And then if that's the case, why can't your local bank issue a currency? And then really every currency should have to compete with any others. And so you can see these narratives around gold, around competing currencies, around non-state currencies. These are all precursors to what became the cryptocurrency boom, right? And so you can trace the lineage of cryptocurrencies intellectually straight to the cypherpunks, and the cypherpunks to the Austrians.
Right.
Yeah.
So I think what's interesting is that, Bitcoin was designed, well, it happened right after the 2008 financial crisis, and there was a lot of distrust. Yes. Right, yes. In the financial system, and I think was it either TARP certainly Obama supported it. The Troubled Assets Recovery Program,
toxic asset relief plan. Yeah, toxic relief asset plan is always very toxic asset. What a just visceral word, right? Right.
But basically, what the U.S. government did was they took all these junk assets, and the Fed basically bought those assets. So they printed money to the tune of something like $1 trillion, which they borrowed from China. And then after they couldn't borrow from China, they just started printing money in something they called quantitative easing. And so all of this happened while Bitcoin was there. And I think one of the things that propelled them intellectually, right? They're thinking, you really can't trust governments. Governments is going out there to bail out Wall Street. And so let's have our own currency. And so, which I think fast forward to 2020, right? Pandemic, when pandemic hits and the crisis that's brought by the pandemic, that's exactly the same thing we saw, right?
Yeah, there's a very funny, apologies for interrupting, by the way. There's a very funny meme that happened in 2020 that I saw. It maybe went unnoticed, but it's a science fiction picture of a meteor hitting the Earth. And it's someone posting it on Twitter saying, what would you do in this, what would we do in this situation? And it's the end of the world. It's a meteor hitting the thing. And then the top response is lower interest rates, right? Right? Like, it's right. And so to your point, it was I think 2008 was an eye-opening moment for many, because you place trust in a financial system that you think is looking out for you, and that you think is kind of fair in some way, And certainly, I think there was a lot of distrust because in the years preceding '07 and '08, there were a lot of very high profile bankers and hedge fund managers, and it was a very very wealth generating period for them right up to the crisis. And then, in theory, in a fair capitalist system, people get to benefit from that upside, but then when it fails, they should fail properly, right? Your government should not, if you believe in a capitalist system, if your government lets them participate in the upside, they should also have to participate in the downside. And so they should lose their jobs, their companies should go bankrupt. And so many of these companies that were maybe not careful and participated greatly in the 10 years prior upside were saved from taking any of the downside risk. And so many in our community felt this was radically unfair, right? And this manifested in many different capitalist and anti-capitalist ways, which is there was Occupy Wall Street. There were different movements saying very much protesting this. Actually, the cypherpunks protested this by saying, hey, we know that there are elements of this financial system that are not working, right? And so what would a financial system look like where we don't have to trust anyone, right? It would be something that you can't tamper with, you can't inflate money, you can't bail people out, and that was Bitcoin. Bitcoin was raised. It was the white paper was released on Halloween 2008 on the cypherpunk mailing server. I think that's around the time Lehman was going under. Very serious moments. It was launched on January 3rd, 2009, and in what was called the Genesis block, the very first block of Bitcoin. Basically, a Bitcoin block is a set of information. So if you wanted to spend money to write information into the block, you could do that. So in the first block, information was decoded into it, which said, I think it's something like January 3rd, or the Times of London, January 3rd, 2009, Chancellor on brink of second bank bailout, right? So in the creation myth in the creation story of Bitcoin, Satoshi Nakamoto, the creator of this thing, is viscerally aware of bank bailouts and quantitative easing, and are very likely the ways that the financial system did not look out for, lost trust in many ways, right? So it intellectually is very closely tied to this history.
So, I think going back to 2020, that's exactly what we see. Massive expansion of the money supply in early 2020. And maybe I should go back. One of the things that that has been observed about Bitcoin and the way, people like to say that it's very, very volatile. But actually, my understanding is that Bitcoin adheres to what's known as technical analysis. In other words, it behaves in the same way that, say, stock markets behave. Yeah. Can you explain that a bit?
Yeah, absolutely. So let's start on the stock side, right? So, there's multiple ways to analyze a stock, right? So you'd look at the fundamentals of the stock, you'd look at the business, you'd look at its cash flow, you'd look at things like, maybe a stock is the wrong thing here. Maybe look at a commodity. I think Bitcoin is actually better to probably compare to a commodity, right? And so the use of a commodity like a grain is that you farm it, and so there's some issuance, and then you consume it or what have you. The use of a Bitcoin is storing value, right? Is storing value outside of the financial system, right? And so it has a direct value of how much value you can, its value is what you can store outside the financial system, right? And so that is its use case. So, a commodity, so it has some fundamental, it has, some market fundamentals around, issuance, supply, which would be farming, farming a grain. It would be, consumption, it'd be demand, it's saying, well, there's, new products, and those new products are going to consume more of it. There's new entrants into the market. There's new companies that consume the grain or consume whatever commodity, right? So you'd have some sort of macro thing. And then on any given day, you have traders who are basically trying to consume all the information available, and they are trying to adjust what the fair price of that asset is, right? And so on the commodity or the stock side, you have traders saying, well, it should be more or less, there's more or less liquidity at the time that impacts the price. But, on the macro, in theory, these traders are all human. They're all looking at many of the same mental models or chart patterns. And so group behavior starts to be something which itself manifests in a chart, right? So there are patterns that happen where, there's, I think you call that one, which was a dead cat bounce.
Cat bounce, yeah.
Yeah. And so that's, it falls for the first time, and then there's a kind of a fake out where you think it's going to recover. And then it goes all the way, it goes down hard again, right? So you can see that in January 2018, literally on the chart in front of us here.
Right.
That's kind of a dead cat bounce, right? And so there's
went down, then went up.
Yeah.
Down, and then so two bounces there.
Yeah, exactly. And so there's chart patterns that map closely to the human psychology, right? Like if things go down quickly, that there's going to be maybe some kind of bounce because people probably got more afraid than they should have. And there's going to be some people recognize that, some proportionate amount of people entering the market knowing that there's fear, and that raises it. And then that, there's the chart shows it the tale of erratic crowd psychology, right? And so to some extent, that erratic crowd psychology over very long periods of time and over large groups of people shows similar patterns kind of over and over again. There's a way in which history repeats
itself,
and you learn a little bit each time, but the entire crowd doesn't learn each time. So over time, it kind of rhymes but doesn't repeat exactly.
So if we go back to this chart, if we're saying that if this is the 2017 chart where it went from I'm looking at 1,000 USD to 20, right? So 20x. We are where? We are somewhere here.
Yes, we'd be somewhere at the
January,
end of, exactly. We'd be in December 2016 or January 2016. Or January 2017. Yeah, something like that would be.
So in other words, we're from January to December, it's 20 times, right?
Yeah.
The last
another way to think about it is,
yes.
I think in January 2017, you just pointed at it when you highlighted it. Back to about $1,000, right? It was at, exactly. Right around there. Comes back to $1,000 for the first time at that point, it would have been the first time in like 3.5 years, right?
That's right.
From the prior all-time high, right?
And
so if you start to think about what 3.5 years is, that's pretty close to the halving cycle, right? And so, right. And so it's, something like that. And so we showed you previously that in late 2013, there was, a giant, what at the time felt like a monumental, just monster rally that went all the way to 1,200. And then it was in a long, and then it went down, and then we saw the dead cat bounce in early 2014. And then it was in a long winter from early 2014 through very late 2016. And in 2016, it started to build slowly, and then it hit its all-time high again. And then in 2017, it was playing a lot. And then there was a period where you thought, okay, this is just too wild of a ride, right? How is this possible?
Right.
And then that was an overreaction, and it pulled back and had its own bounce. And then it's been in a long winter. And then this year in 2020, we've had a halving again. Feels like we've had a build year. We are just right about at our old all-time high. So it feels really like the way 2016 felt. And in fact, there's hype that's building forward again. And if history were to rhyme with itself from prior eras, it would, in theory, 2017 would happen again in 2021, right?
Right. So actually, if you follow what happened, where we are right now, it's somewhere, it could max out at 20x from now. So you're looking at...
And by the way, even though I'm not the attorney on stage right now, I will, I think we are trying to show you some patterns, but what we would say is that this is not explicit investment advice.
Oh, no, it's not.
This is not explicit investment advice, but there are interesting fundamentals that kind of have a recurring pattern that are are worth highlighting, I think. And we can get into some of the other sort of use cases on cryptocurrency and these sorts of things. You know, this is, you know, 20 something could, you know, history has things that have never occurred before all the time. And so we don't know what will happen in 2021.
Yeah, we don't
There's
know
no
what's going to
guarantee.
happen.
There's no guarantee that 2017 would be the same, you know, that 2017 would happen again in 2021 and in the same way. So there's, you know,
but
there's
I think
always,
what we're
you know,
saying,
there's always,
what we're
you never
saying
know.
is that, yeah, right. What we're seeing is that, and you know, who knows if you can believe them, but there are reports coming in, right? I think there was a leaked Citibank report that supposedly some analyst predicts possibly 300,000 per Bitcoin. In other words, there's going to be some movement, right? There's going to be some, it looks like there's some upward movement that we're going to see next year. And that's, I think, driven by a couple, and we'd like to, you know, perhaps try to figure out what's going on. I mean, I think a couple of the narratives are that we're seeing Wall Street going into Bitcoin for the first time.
Yeah.
What would you have to say about that?
Yeah, that's a great point. So hopefully we've highlighted some of the technical basis for why it is secure, why it cannot be duplicated, why it's scarce, right? So these properties are all valuable in a store of value, or these are all very relevant pieces in a store of value. However, large institutional funds require some things before deploying capital into an asset like this. First of all, you know, I think, you know, if you want to put millions of dollars to work into an asset, you want it to be well known, right? You don't, you know, a lot of times these money managers can be conservative and stuff, and so it's been a high risk endeavor for them. That said, you know, in 2020 we started to see some very interesting developments. So we had a few. So one, there's an investment trust in the U.S. called Grayscale Investment Trust, which is basically their demand is about equal to the current supply issuance, just their demand alone, because it's a publicly traded ticker. It's GBTC, and that fund alone gets a lot of fund inflows and is acquired Bitcoin as part of their fund mandate. So that one alone has been acquiring quite a lot of Bitcoin. There's been a publicly traded tech company called MicroStrategy, run by a guy who is now very famous because he's very eloquent about the value proposition of Bitcoin, named Michael Saylor. And he took something like $250 million of his company's treasury. A very large amount of his company's treasury, and he bought Bitcoin end of last year and beginning of this year, and announced it maybe in June. And so suddenly he said, we've acquired hundreds of millions of dollars worth of Bitcoin, and it's going to be our primary treasury asset for us. And actually, it's been so successful that his stock has just absolutely boomed. 175. Yeah.
Oh, 250 plus 125,
yeah.
175, so 425.
Yeah, and what he's going to actually do, which is really compounding his risk, but also he has high conviction, he's going to take out $400 million of debt and use it to buy Bitcoin over the next 5 years. So he is also, so there's Grayscale, there's this company MicroStrategy, and then the other thing is there's been a lot of very legendary hedge fund managers that said, hey, you know what, this is a higher risk, but also higher reward, you know, high risk, high reward version of gold. It has very good fundamentals. It has very good, it has institutions now that help us invest in it. And so, you know, there's been very prominent hedge fund managers like Paul Tudor Jones, Stanley Druckenmiller, like a few other like people that are in the books for a lot of these hedge fund books. And so they've started to express, willingness or more in purchasing Bitcoin. So there are some very, very prominent people. Yeah, Square Inc. It added some because they also have a Bitcoin service. And so publicly traded companies, large funds, legendary hedge fund managers. You know, there are now people that are responsible for pools of hundreds of millions of dollars that are deploying their money into Bitcoin because they see that it's scarce. They see that it's durable. There's an investable value proposition for those particular, funds or pools of capital.
Okay.
And
so
this
maybe
is a new development. Yeah.
All right. So maybe we'll stop there, and maybe just mention that I don't know when, maybe about 2-3 years ago, the Banco Central issued rules which allowed what they call virtual currency exchanges to operate in the Philippines. And basically, what that meant is that you could buy virtual currency and exchange your fiat for virtual currency. And I'll show you a couple of places where you can do that are licensed by the BSP. And because they're licensed by the BSP, these guys need to comply with KYC, right? So it's like a bank. You open an account and they verify your identity, and then they let you trade. So the first one is your former employer, right? Coins.ph.
Yes.
Right. So Coins.ph, you download the app, you open the app, and you can see from the picture of the app here, you have a PHP wallet, you can have a Bitcoin wallet, you can have an Ethereum wallet, that's Bitcoin Cash and Ripple. So you can take your peso, right? And I believe you can just convert it back and forth, right? To trade it, right?
Yep.
There must be one of these buttons here, right? So you can trade from Bitcoin to a peso, etc., right? And then you can cash in. You can cash in from your bank account into the app, and then you can cash out to your bank account from the app as well. But I think if you're going to have higher value, they'll have to do some enhanced KYC for you. Another provider is our guest a few weeks ago, Nichelle Gaba of PDAX, Philippine Digital Asset Exchange. So you click here, you create an account. Same thing, you can transfer money to them. I believe you can even buy on credit card on PDAX, and then you can go ahead and buy and trade there. Third one is a bit more, what's the word? Convenient, is MoneyBees, because they allow you to go to money changers in the mall, right? And you can just go ahead and do this over the counter, and then they can transfer the crypto to you. Now, if you hold your account in say in a Coins account, that means it's on your phone. But if you want more security, I should open that. What you do is you get what's known as a cold wallet. Can you explain what a cold wallet is?
Yeah, absolutely. So essentially it's something that looks a little bit like a USB drive. And what it does is it holds your keys for you. It holds your ability to sign transactions off of the network, right? And so you're able to basically store your cryptocurrency or store the access to your cryptocurrency outside of the network, right? So we talked earlier about, exchanges getting hacked historically. One way to prevent that would be, one way to prevent that kind of hack would be that you basically take the ability to sign your coins off of the network entirely. So a hacker can't hack that sort of digitally, certainly, right? And so, yeah, there's Ledger, which is one of them. It's a hardware wallet. Great question here, which is paper wallet or cold storage. There's a few different things here. So a paper wallet is, in theory, you could actually, you could actually just say your coins are stored on a cryptographic key. Your cryptographic key could just be a string of letters. You could also get a passphrase, which is a series of words that you just record. And so if you wanted to, you could just take that and then send it to that address, and then it's in a piece of paper and you put it somewhere safe. That would be one way to do it. That would be one way to do it if you're just pretty much never going to touch it. Because then once you bring it back, you probably need to do a different process again. And so that would be one way to do it if you're just going to take things off of the network entirely and not see them for years at a time. The other way to do this would be a hardware wallet, which is like the Ledger that we're looking at here. It's like a USB device. Instead of having it on a piece of paper that's stored off the network forever, anytime you need to use your transaction, you would just come back to the network and plug your device in and sign it that way. Trezor is another one. And so yeah, this hardware wallet would be a secure way to do it. So these would both be strategies for what we would call cold storage, which means they're off the network and they're not hot, right? Hot storage would be one in which your keys are on a network, whether that's in an exchange or in a wallet that you host, but that's still connected to the internet. These would be, that would be the hot storage. And then, this would be cold storage, which is taking it off the network entirely and removing, in theory, if your computer was to get malware or something, your funds would be safe because they'd be in a hardware wallet or in a cold storage.
Right. So now I want to. So what we've told you now is you can easily buy, right? You can easily buy, say, BTC, right, Bitcoin on say coins that feature any of those places, right, that we've mentioned. So here coins, but of course there are other coins out there that you can buy. And so what you need to do, right, you need to be able to exchange your Bitcoin or your Ethereum for other cryptocurrencies. And actually the one place to do that is, I don't have it here. It's your site, right? Which is Binance, right?
Exactly. So I can, I guess a quick plug for the day job here. Binance.com was launched in 2017 by someone that was this guy was just born to build this company. His name's CZ, Changpeng Zhao. And he was the former CTO of blockchain.info, which is historically one of the main wallets. He did trading systems at Bloomberg. He did high frequency trading on Wall Street. He was kind of born to build this company. It is the largest exchange in the world based on active users and based on volume. We can do, I guess something like a Coins PH is helpful because it plugs into the financial system and you can buy the currencies, just sort of basic versions of it. But it's spot pricing. So we have a way to trade spot cryptocurrency, just like other platforms. We also have very robust futures, over-the-counter trades. We have various margin and derivative products. We have savings and yield products. So Binance globally, these are all global products, right? Not to specifically scope to the Philippines. These are all ways to trade crypto to crypto, oftentimes, right? And we in some local countries we've expanded fiat operations as well. But yeah, Binance has a very long listing of products, and because it's so liquid, the pricing is often very, very competitive relative to we're the most liquid exchange in the world by volume, and in the exchange business, when you have the most liquidity, you often have the best pricing, and you can trade very quickly and get the price you need.
Right. So here's an example, right? Where if you want to invest in, say, ADA, that's Cardano, you can take your Bitcoin, right, and then you convert it to ADA. So you could do all these pairs that you can do. Just about any crypto you can figure out. So then you have the crypto on your Binance wallet, and then you can download that crypto to your cold storage.
Correct.
And then that's the way. And then so you're invested. Now,
correct. Yeah.
Now I have to talk about, I guess. So if let's say it's gone up, right? The value has gone up, and you want to get out. Now, one of the things that I think is problematic in dealing with local exchanges. So you look at say any of the bigger changes, and I think the one of the problems that we see is that when the price is up, right, they may not be willing to buy your crypto back, right? And so you want to cash out, but you can't sell your Bitcoin to somebody who's going to pay you cash for it. So one of the things that you could do, correct me if I'm wrong, is that you could go on Binance and you convert it to what's known as a stable coin, right? Like Tether or USDC, right? And so, can you explain what that is? What is Tether? So this is USDC.
Yeah, great. So we've established a few things. We've established the blockchain. We've established Bitcoin. One of the things you can do with this technology is you can tokenize things, right? This is especially true on Ethereum and what we would call smart contracting platforms. And we can get to that in a sec. But on Ethereum, you can create new tokens using the Ethereum blockchain, right? So it's like there's the main blockchain, but then you can use certain you can code up new contracts that use the same security of their ledger, right? And so one of the ways that to do this is manifested in a couple ideas. So one, there's there's people that say, okay, I put $1 million in a bank account, and now I'll give you a fractional piece of that bank account. And so I have, every token is a fraction of that bank account. And so I'll give you a million fractions of it. And so now you have a stable coin where it's redeemable for $1, right? And so then you can say, okay, this is a currency that doesn't fluctuate in value because it's redeemable. It's just like a bank deposit, right? Which is kind of how, oddly enough, paper currency really started, right? You can kind of replicate that model on digital platforms. And then there's other ways that people attempt to create stable coins through different sort of computer algorithms and incentive schemes and stuff. But that gets a little more advanced for I think this call. But essentially, a stable coin is a token that you can use to store value directly proportional to a fiat currency, right? So
right.
It's one that can be used on different blockchain systems, but whose value does not fluctuate, meaningfully at all, right? It's usually pegged to $1. Some other regions have, a British pound stablecoin, a euro stablecoin, these sorts of things too.
So some stable coins are actually licensed by the government, right? So I believe Pax, which I'm showing now, this is Paxos, is licensed, I believe, in New York. Is that right? And then USDC is Coinbase stable coin.
Yeah.
And I believe Singapore also licensed a stable coin. I forget the name right now. So there are some stable coins that are, the government makes sure that it's backed by real money. In much the same way that electronic money in the Philippines is backed by fiat. And so the reason why I mentioned these stable coins, because if it peaks, right? So back when 2017, when it peaked at 20,000, if you had a hoard of say 50 Bitcoins, right? You couldn't go to an exchange. You might have a difficult time going to an exchange and turning that into fiat. But what you could do, right, especially in the Philippines, because that would be a lot of money. What you could do is you could convert it to USDC, right? So then you have this number of USDC, and when the price goes down and somebody's willing to buy BTC, what you could do is you convert it back to BTC and then sell it back to an exchange locally. I'm just saying that that's a way to sort of lock in the higher value by doing the conversion at a higher price. Okay, so I think that's is there anything else you wanted to add? So it seems to me like that's sort of one way that people can go. There's a way for them to enter. There's a way for them to exit. These exchanges will transfer fiat to you. And so that's one way to do it. And there are actually right. And there are actually others. There are other exchanges as well. I think Kraken is based in San Francisco, and I think they also have connections where you can cash out and then send it to a bank account. Okay, so I think that's. Is there anything else you want to add before we close on Bitcoin and move on to Ethereum?
Yeah, no, I do think we've covered a lot of ground. I think the thing I'll maybe say for Bitcoin, which is again, I'll call it my bull thesis, but again, not investment advice. Please do your own research. I can't predict the future. We've talked about a lot of, we're about to talk about a lot of potential blockchain use cases, right? Which are all, nice things, nice areas of upside. But what I would say is, in order, and we've talked about the chart pattern for Bitcoin and all the different, we talked about the chart pattern for Bitcoin and the halving and all of these macro signals. If you strip all of that away, the bull case for Bitcoin is this. Do you believe that the world you need to believe that there is a use case for global state-free, like outside the financial system value storage, right? The way gold has storage. Do you believe that there's a use case in the world for digital gold? If yes, then you must believe that either Bitcoin will stay the same in value, but that global GDP will go up, very likely, or sorry, you believe that Bitcoin's percentage of global GDP will stay the same and global GDP will go up, or you would need to believe that global GDP stays the same and Bitcoin's percentage of global GDP increases. Many people believe both of those things, and in fact, both of those things would happen, right? So right now, Bitcoin is a very, very, very small, very far less than 1% of global GDP, right? I think the entire cryptocurrency ecosystem is $500 billion or something like it's significantly less than $1 trillion still. Global GDP is in the hundreds of trillions, especially when you include all these financialized products. And so,
right. You can talk about the Winklevoss Twins, right?
Right. Yeah, exactly. Like, it seems exciting the way that Bitcoin wealth has been created, but the show hasn't really even started yet because it's such a rounding error in terms of global value storage.
Right now, right. So that's why I wanted to bring up the Winklevoss Twins. These guys became famous with that film with Mark
Social
Zuckerberg.
Network.
Social Network. They famously sued Mark Zuckerberg. So they've invested a lot in Bitcoin, and if you can look it up on YouTube. So they've actually gone ahead and said that they believe the value of the market value of Bitcoin should equal that of gold, and if that's true, then the price would be somewhere in the vicinity of half a million dollars per Bitcoin. That's them. That's their big. They're also invested in the space. I think they also have their own services, and I believe they also. I'm not sure if they have a license exchange. I'm not sure. I understand they were applying for a ETF. I think.
Their ETF did not work out, but they have there's many regional exchanges, and so they have one. There's very particular sets of regulatory requirements for New York. They have an exchange that very closely caters to. Right, it's technically a global exchange. It works in a lot of other markets, but they have scoped it to serve New York, and that exchange is called Gemini because they're twins.
That's right.
Yeah.
Oh, okay. All right. So now we go to Ethereum, right? So as we mentioned, Bitcoin. In the blockchain Bitcoin is the first application for blockchain. And it basically, the blockchain contains, the Bitcoin blockchain contains very little information. It only tells you, who owns, right? Or which Bitcoin address relates to which number of Bitcoins. Now, Ethereum, what is Ethereum?
Okay, so if Bitcoin is a giant global value storage, Ethereum is a giant global computer. That's kind of what they are trying to position it as. But essentially, Bitcoin, in order to be more secure, Bitcoin has a very slender code base, right? For security purposes, they want to keep it very minimal on what you can actually do with a Bitcoin, right? That is a source of Bitcoin's security, is like they've focused on there's a minimalism to it. Ethereum is much more ambitious in the sense that they want a blockchain. So they want the same thing that Bitcoin has, which is a distributed ledger, but they want the tokens on that distributed ledger to have more functionality. I want the token to be able to to pay out on some condition. You want to be able to program the tokens on that particular blockchain with what is called a smart contract, right? And a smart contract is just the ability to do something. It's the ability to make a program that runs on the blockchain, right? An example of a smart contract would be a vending machine, right? Someone spins up a vending machine, and the smart contract for that vending machine is if you receive if you put in a 2 peso, 2 different peso coins or something, I'll give you a Coca-Cola, something like that, right? That would be right. So weird in a weird way, like a vending machine is like a very simple smart contract, right? And someone built that thing to run when it's someone doesn't need to be there, right? Someone doesn't need to you put money into the machine, you get something out of it.
So that's the analogy
Ethereum.
of a smart contract, right?
Yeah, right,
So,
exactly. And so Ethereum
right.
you want to create programs that can run and be interacted with on a global distributed ledger, so no one controls the program. But you want to be able to make these conditional programs on the thing, and so it's a much more this is a technology term actually. It's a much more expressive blockchain. You can you can program it in much greater depth. And so, yeah, because of that, they've been very ambitious with what they'd like to accomplish. And it's not like they're just doing, and with that, the smart contracts, people can create insurance products, loans, derivatives, decentralized trading, video games, futures and prediction markets. People are using it as a platform to distribute digital goods. It's a very, very, I think when you hear a lot about a lot of the things built on the blockchain, a lot of it is built on smart contract platforms like Ethereum. Yeah.
Right. So I was going to look for an application. So there are websites, there's information out there about flight arrivals. So I'll give you an example of what. Let me see if I can share the screen. So you could. This is kind of difficult to do. I don't have a flight number in my mind, but you could enter an airline, right? And this is information that's publicly available, and you can find out what time a flight left, right? So you can tell whether it was delayed or on time because the published intended departure time. And so you could enter that into a smart contract. We'll say, okay, I'm going to deposit, let's say 0.0005 Bitcoins into this smart contract. And then an insurance company is going to deposit, a payout, let's say of 1 Bitcoin. And it says that if your flight is delayed by more than 3 hours, which the smart contract as a piece of software, right, we look at this site. And when they see that it's been more than 3 hours from the intended flight time, then the smart contract will automatically credit the 1 Bitcoin to your Bitcoin address. So that's an example of like an insurance product that's completely automated. You don't need people. You just need somebody to program it. And then once you put in the premium, so to speak, then it triggers a deposit from that end. And then when the event happens, then the money is paid out. If the event doesn't happen, then your premium goes to the insurance company. So that's sort of one example, of a smart contract. Okay, so Ethereum is this thing where you could build other things on top of it, and one of the things I think we saw in 2017 and drove that bull run was this thing they called ICOs, right? Where companies were starting to issue their own coins around business ideas, right? And can you explain what ICOs are?
Yeah, sure. So one of the features of a smart contract is a smart contract programming language is you can create a token, or you can create a smart contract, and if you send money into it, it gives you a token back, right? It gives you a new token, right? So I send Ethereum and I receive Kyber, or I receive, some other token, right? And so in 2017, while there was a lot of fervor about cryptocurrencies, there was a lot of very speculative use cases trying to spin up smart contracts in order to make money. And so that was a big speculative drive that drove the price up, I think. It was, it's very clearly, a major feature of a major attribute of the 2017 rally. And so, people were buying Bitcoin and Ethereum in order to send them into smart contracts and speculate on ICOs, right? So there was, it maybe got a little bit out of hand in that it drove speculative fervor. It was, maybe people that weren't professional investors or doing proper due diligence, and some of them certainly worked out and made people very rich. But those stories would then be sold to others when when less valuable projects were coming to market.
Right. And so a lot of those ICOs, they raised money. I think there were even a couple from Philippine companies. No, I believe what's that? The HR company.
Solarium did one, a couple others. Yeah. And these were
Bloom. I think Bloom did one also.
They explored one, I think, and then did not end up doing it.
Oh, they didn't. Okay. So,
I'm not sure, but that's not a core feature of their business anymore. And yeah.
Right. So you can start with a very low amount, and that can grow into a larger amount. But I think some of those companies that went ICO were building this new thing that we're seeing a lot of adoption now, which is called decentralized finance, or DeFi. Can you explain what DeFi is?
Yeah, sure. So in order to build higher quality smart, so people learned that there were some very low quality smart contracts in 2017. And so there, during 2018 and 2019, which we called the crypto winter, some teams continued to build on smart contracts without the hype, and they were building, I think much more thoughtful smart contract products, right? Oftentimes they didn't have a token yet or anything like that. They just built what we would call maybe financial primitives, right? They built smart contracts that could do just very simple financial interactions. But so people built so many of them that they could interact, right? So it's one that is decentralized exchange, one's a margin product. Okay, so you can have a decentralized margin trade, or you can build, so basically decentralized finances, there's all of these building blocks that allow you to do very specific types of financial transactions. But because they're all built on Ethereum, many of them are built on Ethereum, all of these single smart contracts are actually compatible with one another. And so the decentralized finance movement is, you have all of these financial services that are open source, not controlled by a single party, and they can all interact with one another. And so right now there's this big movement of basically innovation in structured finance. And so, I think one of the things that the blockchain does is that, historically it has taken financial services that were once the province of very rich people and have given it to not necessarily everyone, but everyone willing to learn the engineering required to do it, right? So arguably a Bitcoin is, access to Bitcoin was once a Swiss bank account, and now it's a Swiss bank account in your pocket, right? So you can access it that way. What DeFi is once upon a time, there, large investment banks, and once upon a time, this still is the case. If you wanted to build a very strange custom derivative or some sort of risk instrument, you would go to a structured products desk at a large investment bank like Goldman Sachs, and Goldman Sachs's lawyers would structure a contract for you that tranches off risk in certain ways, right? And now, makes a bunch of conditional statements about the outcome of some derivatives contract, these sorts of things. And now with smart contracts, you can make these contracts, instead of legal contracts, you can do these via code, right? And so there's all of these compounding financial services that are building off of one another and allowing very smart engineers to build structured risk products, right? And the difference is, because Bitcoin and because Ethereum are not promissory, right? So they're bearer assets. These compounding risk products are not built on leverage the same way that traditional finance is. They are instead built on collateralization, and oftentimes over collateralization to hedge risk. So yeah, it's an innovation in structured finance, and instead of just a small handful of very elite investment bankers accessing structured finance with their lawyers, it is a lot of brilliant engineers globally learning how to combine these primitives and build interesting financial yield products.
So I'm gonna show something. So this is Aave.
Yeah.
And then I'm looking at, so maybe you can explain this, because this, so you have yes, USDC, borrow, and then there's an APY. What does this mean? Does it mean if I deposit? Yeah, go ahead.
Yeah. Aave is one of these structured financial primitives, and what they are is they are a money market fund or a money market token, right? And so they will let you basically if you deposit with them, they want to lend your funds out, but they'll give you an annual percent yield. And so they are, they're doing core banking services, right? So these are all assets that you could put into there, right? So you can see DAI, which is a stable coin, USD coin is stable coin. So these top ones are all, there's the Binance USD, that's a stable coin that our company has launched. These are all money market funds for these things. So you can say, if you want to borrow money from Aave, you can borrow Binance Dollar at 4.11%.
Okay.
And then actually, if you want to lend money to Aave, you can lend it and get a yield of 2.56%. So it's a money market fund, right? But it's decentralized. It's
decentralized.
Yeah, exactly. So,
and it's run by a smart contract, right?
Correct. Yeah. This is not run by a bank. This is not run by a financial institution in a given location. This is a thing that is programmed and open source and fully auditable on the blockchain that no one owns and no one controls. It exists as its own independent financial service that is just on the internet natively in decentralized way. Yeah.
I think one thing to remember about smart contracts is that there is a risk on a smart contract that either that it could be hacked, and I think you can buy insurance against that sort of, or
correct.
Either
correct,
hacked or there are bugs.
Correct. So
you don't get your
Right. So again, I'm a very big fan of Ethereum and of DeFi, and it's a key piece of Binance's business. Remember what I said. Bitcoin is the largest network with the most hash power. It has a much smaller code base in order to prevent, it's the surface area of things that could be hacked is much smaller. Ethereum's goal is to be much more ambitious, right? So Ethereum has a great track record, right? It hasn't had really existential problems yet either, but it's also much younger. So much more is built on top of it so there are, whereas for Bitcoin, there have been instances where the exchange has been hacked, and that's a problem of an individual company. There have been smart contracts that have gotten hacked because someone didn't program them carefully. So there's more upside potentially in like a DeFi situation, but then also DeFi is very risky, right? Like these, there's just multiple additional layers of risk is all. Right. So yeah, but also multiple, what it's doing is also very ambitious, and so maybe there's also more upside. I don't know. It depends on the project, right? So I don't want to.
So actually, what you're saying is that, what you're saying is all of this is currently running on Ethereum. A lot of these, DAI, True USD.
All of these ones interoperable with Aave are based on Ethereum. Yeah, but there are other smart contract platforms that compete with Ethereum, and they try to have their own decentralized financial services. What Ethereum has, they have a large lead, and they have, to some greater extent, they have much stronger network effects than many others in the ecosystem. Yeah.
Okay, so now I'm showing Uni Swap. What can you tell us about Uni Swap?
So Uni Swap is a decentralized exchange. So whereas Binance is a centralized exchange, Binance has its own decentralized exchange product as well, but we're most well known for our centralized exchange product, right? So we have a single order book that allows you that matches your trades with the users. What you have in Uniswap is a decentralized exchange where people pool their liquidity and allow for trades to happen in a different manner. So it's not a matched order book in the same way. It's a little bit of a different mechanism, but essentially it allows for decentralized exchange services, right? And
so I could do this, for example, and then I can get my turn my Ether into USDC, right?
Correct. Yeah.
And then the pool is you basically investing your crypto in exchange for some return.
That's correct. So because it uses a different, in order to be decentralized, it uses a different method than an order book. And so what it instead needs at any given point, it needs a lot of liquidity. And so if you add liquidity to the exchange, they will give you, oftentimes you can earn a reward by taking transaction fees on all trades in the liquidity pool.
Right. Okay, how about Curve?
Yeah, Curve is a way to optimize yield, right? So there are a couple of money market funds, like you showed us Aave. There's also Compound. There's a lot of these other
Compound.
There's a lot of these other money market funds showing up, and Curve is a way to invest money that optimizes across money market funds.
Yeah.
So
this is crazy, right? So we got 25% per annum yield.
Exactly. Yeah, but you can start to, but that's exactly what's happening, right? Is you start to have one piece, right? So you can see Curve interacts with Compound and interacts with, interacts with Compound and interacts with Aave and interacts with like USDT and other, these are all single pieces. And then you start to build companies and products by combining all the pieces, and you can increase the scope of risk and increase the complexity of these financial services because they're all compatible with one another. You can't, in traditional finance, financial services really aren't compatible with one another, right? You have some layers that are combined like Visa and stuff, but like I have to choose between, going to, BPI or BDO, and like my services I can't say, oh, I want the services of one bank, but not the other. And, you have less freedom to optimize across the things. And DeFi, more than anything, is the freedom to optimize across compounding financial primitives, right? Yeah.
Or asset classes.
Exactly. Interoperable financial services, essentially.
Right. And I think, I don't know, one of the things that I haven't really figured out is whether, DeFi actually makes markets more transparent. I think that's one of the things that they'll probably want to figure out.
I think what maybe the most correct answer is to say it makes it more complex, right? So there are people who are not paying attention who are probably worse off because of the complexity. And there are people who are paying very close attention who are probably better off because of the complexity, right? So complexity, it remains transparent, but complexity increases opacity, right?
Right.
Like it is all technically still transparent, but it becomes harder to track, it becomes harder to keep track of each of the interoperable services, right? So, if it's a single smart contract, someone can audit the contract, but if it's a smart contract that operates with another one, and that other one is operating with another one, and you have, multiple lines of smart contract interaction, it compounds because a single piece of it might increase the risk dramatically, right?
Okay, and all of these DeFi projects have their own coins. Right? You can invest in an Aave coin.
Many of them do, yeah. Many of them do, not all of them.
Right. Yeah. Okay. And then, so the way I like to think about it, and of course, all of these are driven. A lot of them are driven by Ethereum, right? Yeah. So the way I and see if my thinking is correct. So the oldest crypto, the granddaddy is Bitcoin, right? Yeah. Right behind it is Ethereum, which is driving this whole ecosystem. And so as the ecosystem expands, Ethereum becomes more valuable. There's more demand for Ethereum, and the value of Ethereum coin is likely to go up as the ecosystem gets stronger. DeFi is only emerging, and therefore these are sort of early days for a lot of these coins. And if you're a risk lover, right? These coins, I think the ones that drive DeFi are probably the riskiest. Some of them are going to fail.
Yeah.
Some of them are going to go to zero. Right.
A phenomenon that happens is the deeper you go into the crypto space, the more warped your sense of risk becomes, right? So if you're deep into if you're outside of the crypto space, you just think that the world of cryptocurrency is just this wild risk product, and wow, Bitcoin, I wouldn't want to put too much of my portfolio in that, you know, those sorts of things, right? Rightfully so. There are very serious risks involved in investing in Bitcoin.
Yes.
But kind of like that chart pattern where it's, you know, you would call it fractal, right? Like it's different, you know, it continues to rhyme at different scales, right? So if you're looking at the whole spectrum of financial risk, you know, Bitcoin seems very risky because it's over the end. But then if you expand just the set of cryptocurrencies, man, Bitcoin has a proven use case, a much longer track record of going uncompromised. And you start to, you know, things start to look, you know, on a relative risk basis, you know, there's a lot of people trying to create complex risk products. And so relative to Bitcoin, they do seem, it is a wild west, even within our own community.
Right. So I think that's a good way to put it. I mean, I like to think of DeFi right now as like a rabbit hole. It's like you go in and then you're right. I mean, it might be a different sort of reality in there as you are moving through that. But I think what is clear is that a lot of these are likely to drive Ethereum, adoption of Ethereum. And from the way it's shaping up, I think the future is that it's shaping up that Bitcoin is going to be a store of value, but financial products, right? The new financial systems will probably be driven by an Ethereum ecosystem, not by Bitcoin. So
yes, so far Ethereum has a very serious lead.
Right.
So does Bitcoin, right? Like it's hard to say. Both of their leads certainly are very far leads, right? Like and very likely it will play out where these things follow power law distributions, right? So
yeah,
the largest cryptocurrency is going to be valued, you know, maybe more than all the other ones combined, and then the next largest is going to be valued probably more than all the others. Like it's really
right.
this power law return. It would be very, you know, I think certainly there are other teams trying to make an attempt for parts of the Ethereum ecosystem. Ethereum has, you know, very serious advantages with price and network effects and developers, and so it does seem to have a very large lead. But I think there are some teams that still think. I don't think there's really that many teams that think that they can make a better digital gold, right? Like I don't think there's a lot of teams trying to build a better digital gold right now.
Right.
I do think there are a lot of teams that will try to go after Ethereum's market.
Right. And I guess it's like
you know, very talented people in those teams too. Yeah.
Right. So it's like in personal computing space, it's like you know, Ethereum could be Apple too, right? First on the scene, builds a developer base, and then right, Microsoft and IBM comes in, and I want to pivot now to what I think is one of those potential competitors, right? And that would be Cardano. Would that be correct? So Cardano is like an Ethereum
it is correct.
competitor.
Yeah, it is correct that they are hoping to compete with Ethereum. Yeah.
Right. And what they want to do is they want to make, I guess, my understanding of Cardano is that they, in fact, I think when I read their white paper some years back, it was all theoretical. They didn't even have any tech, right? Basically, they were saying, we're just going to avoid all the mistakes that Ethereum made, and we're going to make it better. But I think what we've seen at least in computing, right, that sometimes the better technology doesn't necessarily win out, right? So some people would say, you know, Unix is better than say Windows, but Windows has more mass adoption. So it's again, as you said. So
right. Yeah, it's not. Strength of technology is a single factor, but it's certainly not the only factor.
Right. And maybe just pivoting back to Ethereum. There's something recently that happened with Ethereum that maybe might be worthwhile discussing because one of the criticisms of Bitcoin is that the way it mines or adds blocks to the blockchain is very energy inefficient, right? It costs a lot of electricity, and so that's because of what they call the proof of work. And now they're shifting to something more energy efficient called proof of stake. Maybe we don't need to go into the difference, but can you explain like what's going on with Ethereum, because Ethereum is
absolutely. So Ethereum as it's continued to grow has significant network demand, And in order to make interactions on the Ethereum blockchain, you need to pay a fee. You need to pay a network fee. And actually, we never talked about network fees as part of the blockchain in general, right? Like that is another big piece of Bitcoin as well. But yeah, every transaction on the blockchain takes a small fee. And as demand for Ethereum has gone up, demand for using Ethereum has gone up, network fees have gone up, and they've gone up in a way that makes it more difficult to use. And so this is a concern for its long-term scalability, because people want to build a lot more services on top of it. And so, there's been a number of different discussions on how to solve this. And so Ethereum is making a major upgrade. So there's going to be Ethereum like version 2 or 2.0. And this will make significant changes this hopes to make significant changes and upgrades to its ability to scale, essentially, right? And so there's sharding, these are the things, right? So there's basically ways to split up the size of the blockchain. There's ways to do things off chain. There's ways to kind of reconfigure the blockchain so that it allows more transactions to go over time, right? So it doesn't cost as much to operate it, and these sorts of things. So this was a major development, and it pushed out earlier this month. And I think it'll be a key piece of the 2021 narrative for crypto, right? Is did Ethereum do it right? Did they figure it out? And if they did, it probably would ruin the narratives of a lot of would-be Ethereum competitors, right? So yeah.
Right. Actually, I think somebody told me a few years ago, I thought it was quite a smart thing to do, is that it's very hard to say push Bitcoin away from its dominance, because whatever improvement there could be in another coin, Bitcoin could just adopt it. It could just, right? I mean, so I think. Okay, go ahead.
I thought that was if someone, I'm not sure when someone told you that. I would have believed that if you had told me that in the year 2016, in 2015, 2016, I would have believed that. It is incredibly difficult now to push an update in Bitcoin, right? Like it is by far the most conservative crypto project. It is very hard to make very simple changes to Bitcoin because people are so afraid that a minor change could create a vulnerability. It's such a scaled project now. Right. And so even performance updates, these sorts of things, they would much rather solve them through other indirect methods than to ruin Bitcoin and its decentralization, which makes it frustrating because there may be upgrades that would be helpful to Bitcoin. But also, it's nice to have a very conservative blockchain that doesn't want to mess up its winning formula, right? So in theory, they could adopt better privacy protections, better scalability, better, things for transactions. But in practice, it is, there's no one that gets to say yes. There's no one that singularly gets to say, yes, we are going to make this change. Right?
Correct.
And so anyone there's been people that have tried to make changes, and the main Bitcoin did not, the main Bitcoin miners, the main Bitcoin validators, right, did not agree with the changes. And those projects forked out, right? And so what happens if two different sets of parties disagree on what the core code base should be, their code bases just start running independently of one another, and it forks, right? It's like a river, right? And so that's how Bitcoin Cash was created, because the Bitcoin Cash people and the Bitcoin people disagreed on the fundamental value of what Bitcoin's supposed to be. One said it's supposed to be for payments, so we should change the block size and other things. The other said it's supposed to be for value storage and digital gold. And so they had different roadmaps, and now Bitcoin Cash is its own thing. And then even within Bitcoin Cash, they said, one side said it's supposed to be, eventually we're supposed to have a block size that adjusts. The other says, no, we should just double the block size every certain amount. So they switched. And so now there's Bitcoin Cash and there's Bitcoin SV is what it's called, Satoshi's Vision. And then now very recently, even Bitcoin Cash is forking again to two different. So in the Bitcoin community, especially, it is so difficult to pass upgrades because people have such a strong definition of what Bitcoin is, and it's very conservative about making any sort of change at all. That is a very serious, feature because Bitcoin has survived for so long. And then also it's very difficult to make changes. And actually, that's one of the things that's impressive about how ETH was able to upgrade at all, right? Like the idea that yeah.
That's what I was going to say. That's what makes this a lot more.
I'm sorry,
impressive.
I beat you to your point. Yeah, it's very hard to make changes in a decentralized milieu, right? Like in a decentralized environment.
Right. I mean, so the fact if Vitalik Buterin, right, pulls this off, right, and it looks like he will, then it shows that there is a way. It's not easy, but there's a way that you could fold in, because the problem is the more difficult it is to fold in these developments, it might happen in the future that people might opt for a different technology that does the things that they wanted to do. But so currently Ethereum seems to be sort of fighting. So it's sort of like an existential fight, I think, almost, that they need to change, because otherwise somebody might come in and take over. So so great. I think that about does it for us, unless there's maybe you have some closing thoughts for our viewers.
I think a favorite one that I like to think about is I guess we've been I think this was a very optimistic conversation, right? This is we talked about a couple of very the two largest projects in the cryptocurrency world. We've talked about what their value propositions are. For starters, things could go wrong in either of these projects, in either Bitcoin or in Ethereum, right? People get blindsided all the time. And then also, there are other projects that are exciting. However, they also, might have risks that are unforeseen, right? And also, because there's so much optimism in this space, I think you can potentially hear that it's something I'm very passionate about. There are others like me that will talk about kind of the wonders of the cryptocurrency world and why it's an interesting new set of financial system in many ways. I have a saying, which is that snake oil is always sold on the frontier, right? So there's going to be other projects that might not be as that are very likely going to not be as careful or not as battle tested, or new or experimental, and they're going to promise some great financial future. And so you should always be very careful. You could be very careful about everything we said here today, right? Like, research these things for yourself. It could be that Attorney Decypting and I are very, interested in certain things, and we're overlooking very, very serious risks. And so there's a lot of projects that are going to promise very exciting returns, very exciting sort of, world-changing, impacts. And, please be very careful, right? Because I think there are a lot of risks in this space. There are a lot of people who have, there are a lot of people who've made great fortunes, but because of that, there are also people who have been taken advantage of by people who want to make great, there are people who have also wanted to make great fortunes who have been taken advantage of and at great expense, great personal expense to themselves and their families. So, understand that it's still a high risk space, a high risk endeavor. There are technical topics that people will try to use to pull one over on you, and so it's a high risk space, and so conservatism pays a premium in a sense, right? So. I even though I'm at an exchange that allows you to buy and sell many different types of cryptocurrencies, don't even let that substitute for your research process, right? Try to understand, try to find, compelling people in each cryptocurrency or in each project that can give you kind of a point of view. Definitely never invest in anything that promises. I'm sure this is a much higher context audience than most, but definitely don't invest in anything that would ever promise a return or these sorts of things. Try to figure out, try to find when you're doing research, maybe try to find a positive article and a critique. If someone is very bullish on a topic, right, whether that's on Twitter or Facebook or wherever they're discussing it, try to ask them if they have a critique of their own of the token as well, right? Try to see if they're self-aware. Try to see if they are, not blinded by greed, if you will. And yeah, I'd say.
Can I ask you something? Sorry.
Yeah.
Maybe as a final, because I feel like a lot of people are gonna, after this, they're gonna go on YouTube and they're gonna do a search, and there are all these people, right, pushing, giving their opinions on crypto, and maybe, what opinion or what sort of advice can you give in relation to those guys?
Yeah. Look. So figure out what they're really selling, right? Figure out what they're really selling, right? So it might just be someone that's an investor, and really they're not trying to tell you about a currency. They might just be someone that trades chart patterns, right? They might be someone, they're like, sometimes people have different investment horizons, right? You might be trying to say, you might want to allocate a little bit of money in here for a retirement portfolio, whereas you might stumble into someone who's a day trader, and he or she's trying to make a return in the next 2 hours, right? So there's a whole ecosystem of people to be careful of, and you got to find someone that really aligns with your own goals. Another thing, by the way, that I look at in general is don't ask for investment advice. Instead, ask what the person holds in their own portfolio, right? There's this concept of revealed preference. Advice is cheap, but instead you want to know what they do with their own money and why, right? So that's something I ask, not even just for investment advice. That's probably just a good rule of thumb for advice of any kind. It's you don't want
skin in the game.
Take advice. Yeah, exactly. You don't want to take advice from anyone that would not take the advice themselves, because then that reveals their own preference, right? You want people that would understand, that would lay it on the line, right? Like I'm not telling you to buy or sell Bitcoin, but I do happen to own a bit of Bitcoin, right? So you can understand my own financial preferences for that, right? So I'd say be careful of people giving advice that they wouldn't take themselves. It's probably that's probably my best life advice in general. Yeah.
Thanks a lot, Colin. So thank you for joining us. I want to do a shout out for the people who are joining us. We've got people from Makati, Baguio, Cavite, Baguio City, Laguna, Mandaluyong, Navotas. We actually have somebody coming in from Malaysia.
Cool.
Yeah, Dasma, Cavite, Makati, Quezon City. Where else? So think Mandaluyong City, Cebu. So we just don't have anyone in Mindanao. I like to have Luzon, Visayas, Mindanao. But it's interesting. We have somebody from out of the country, so it's an international audience.
Fantastic.
We have today.
Yeah, we're expanding. We're expanding our horizons, certainly. Yeah.
Right. So I guess this I feel very optimistic about what's going to happen in this space. It's exciting, even just from a technology adoption standpoint. So I was reading a column by a financial historian named Niall Ferguson that he published on Bloomberg. I don't know if you caught that, Colin, where he said that...
I didn't, but I'm familiar with Niall Ferguson. Yeah, certainly very strong intellectual. Yeah.
Exactly. So yes, he actually a very very good book called The Ascent of Money, where he tracks all the history of banks and stock markets, etc. So he wrote this column in Bloomberg a few weeks ago, where he said that in the Black Death, in the Middle Ages, when the Black Death happened, financial transformation happened, and monetization was happening. People started using money, right? And then his point was that this pandemic is doing the same thing. It's compressing a lot of timelines. Like, what are we doing now? We're on a webinar right now. I mean, if you told me last year, when are you going to do your first webinar? I would think, I don't know, maybe after 5 years, right?
Yeah.
And then 6 months later, I'm doing one every week. So
yeah, exactly.
It's insane. Yeah. So
we're on a video conferencing software. People from all around the country, from all over the country, and now across the region in Southeast Asia here. you and I are not physically present, but we were able to prep for this conversation, and it's quite convenient. Yeah.
Right. So that's what we're seeing. In fact, DeFi, I think, exploded this year as well. The adoption has been incredible. So we're seeing, the bad thing is that we're also locked up from each other, and the world is out there waiting to be rebuilt. But I think we're going to emerge there, a very different world, and with a lot more adoption and change than what we bargained for. So I think that's on that note, I'd like to end this year's series of Digital Transformation Thursdays. I thank you all for joining us in this sort of crazy journey that when we started organizing this, it was to celebrate the 20th year of our firm, and we did everything on a haphazard thing, and I think we've gotten a bit better at it. We're as you can see, we're just bootstrapping everything, but we'd like to think that we'd like to spend money on the things that are important, which is content. And on that note, I'm very happy that Colin has been really providing us some really good information, as with all of our speakers who've shared all their knowledge and their expertise, helping all of us navigate this digital transformation space that whether voluntarily or involuntarily we find ourselves in. And on that, I'd like to end this episode of Digital Transformation Thursdays. Thank you, and we'll see you next year when we start up again. Thank you. Merry Christmas, and have a Happy New Year.
Thank you.